Picture a boardroom at dawn. Glass walls, global clocks, and a map aglow with red-white maple leaves instead of the usual coastal US hubs. In the last 60 days, 5 multinationals, from AI giants to Spanish toll road investors, have quietly wired billions north of the 49th parallel. They're fleeing tariff whiplash, data subpoenas, and regulatory gridlock, and they're betting that Canada's calm beats America's chaos. On paper, it looks like a trickle. A hyperscale data center announcement here, a rail line upgrade there. Zoom out, and it's a coordinated capital migration reshaping North America's economic spine. The thesis is simple. Certainty is the new gold. Canada's measured policies, stable permits, and data sovereignty laws offer a decade of predictability. US executives can't match. So the money is moving, silently but decisively. And this is only the prologue. Because the first industry to bolt isn't retail or mining, it's the cloud itself. Next up, the billion-dollar AI sovereignty surge that's rewiring British Columbia and Quebec into one massive neural engine. Imagine a nation hardwiring its own neural cortex. That's what TELUS just triggered with its 70 billion Canadian dollars. NVIDIA-powered Sovereign AI Factory, 2 megaclusters in Kamloops and Rimouski built to keep every byte of Canadian data beyond the reach of the US Cloud Act. Executives call it legal redundancy. If Washington can subpoena foreign servers, then the safest cloud is the one you own at home. Bell answered in kind a week later, unveiling AI Fabric, 6 hyperscale data centers across British Columbia, capable of 500 megawatts of compute and running on Grok's lightning-fast inference chips. Together, the two telcos are welding a national AI backbone that never crosses the border. Their public rationale is capacity. Their private rationale is certainty. Canadian data sovereignty rules spell out where data lives, who can touch it, and what it costs to power. No midnight executive orders, no export control curveballs. The ripple effects are immediate. Fintechs that once defaulted to US clouds are pre-booking rack space in Kamloops. Health tech firms see a compliance shortcut, store patient records under stricter Canadian privacy laws, and sidestep trans-border red tape. And investors read the subtext. If the cloud itself is relocating north, the rest of the stack will follow. But fiber cables can't move freight or minerals. To see how physical goods are rerouting just as fast as data packets, we jump onto steel rails racing toward the Atlantic. Canadian National Railway just greenlit 80 million Canadian dollars to fortify tracks, yards, and its Autoport terminal in New Brunswick and Nova Scotia. The upgrade isn't cosmetic, it's a pressure valve. In April alone, Canadian exports to the US crashed 15% after Washington doubled metals tariffs, exploding the trade deficit to a record 7.1 billion Canadian dollars. With southbound flows throttled, CN is rerouting freight eastward. The strategy: load containers straight onto Europe-bound vessels at the naturally deep, ice-free port of Halifax, which sits 2 sailing days closer to Hamburg than New York and plugs directly into CN's mainline. The rail-to-sea handoff slashes tariff exposure, dodges border bottlenecks, and lets exporters chase higher-margin EU buyers. Early signals show the gambit working. Halifax's 2025 capital plan now centers on an integrated rail solution to absorb the surge, while CN's investor deck touts Atlantic diversification as a core hedge against US volatility. In boardrooms from Montreal to Madrid, the message lands. If goods can't roll south, they'll sail east, and the rails are already laid. Those container ships aren't the only foreign capital landing in Ontario, though. Next up, why European billions are pouring into a single toll road, and what that says about Canada's risk premium. Spanish infrastructure giant Ferrovial just wired 1.99 billion Canadian dollars to scoop up an extra 5.06% slice of Ontario's 407 ETR, nudging its control of North America's busiest toll highway to 48.29%. One board vote shy of outright command. The 108-kilometer all-electronic route already moves more than 3 million drivers a week and spits out inflation-linked cash flows until 2098. So why grab even more now? Ferrovial's CEO spelled it out. Yield is great, predictability is better. With US highway public-private partnerships stuck in political crossfire, Billions in already approved infrastructure funds remain frozen or challenged in court as Washington toggles between green lights and shutdowns. Ontario's toll formula looks like a Swiss watch. Tariffs can't dent it, congressional gridlock can't stall it, and a single provincial minister, not 24 federal committees, sets the rules. The market read the signal instantly. Bond desks marked 407 ETR paper quasi-sovereign. Australian pension funds reportedly circled minority stakes at a sub-4% discount rate. And analysts at TD raised their 12-month target on Ferrovial by 9%, citing North American risk-off arbitrage. In short, foreign capital has decided that if you want North American growth without U.S. volatility, you plant your flag in Ontario asphalt. And where steady toll cash leads, real estate money follows. Next up, why storage REITs are racing to lock down every spare square meter in Toronto. Last week, Strategic Storage Trust 6, an affiliate of SmartStop, cut the ribbon on its 14th Canadian facility and 12th in the Greater Toronto Area at 1480 Jane Street. The 6-story fortress packs approximately 105,000 net rentable square feet and 1,200-plus climate-controlled units, planted on a tight 2.7-acre parcel that sees 40,000 vehicles roar past each day. It's the latest link in a 3-year land grab that has more than quadrupled SmartStop's Canadian footprint, while new U.S. projects idle on drawing boards. Why Toronto? Because red tape here moves at warp speed by American standards. A complete building permit application in Ontario must be reviewed in 20 to 30 business days, about 1 calendar month. Compare that with California's own lawmakers conceding an average 3 to 7 year slog for comparable approvals, even after permitting reform hearings. Add Texas-sized land acquisition costs that have quintupled since 2022, and the math points north for institutional landlords. And demand isn't guesswork, it's demographic physics. Canada welcomed approximately 472,000 new permanent residents in 2023 and targets 500,000 a year through 2026, the fastest sustained population surge in G7 history. More people, tighter condos, and pricier real estate mean one thing. City dwellers pay a premium to stash everything that won't fit in 600-square-foot micro-lofts. For rents, every corrugated locker is a bond with doors and padlocks, cash flows indexed to immigration, not Wall Street mood swings. Yet the most valuable storage bet sweeping Canada isn't corrugated steel at all, it's electrochemical. Next up, the battery bonanza, where billions race to bottle energy instead of spare sofas. Volkswagen fired the starting pistol last year when it picked St. Thomas, Ontario for a 20 billion Canadian dollar PowerCo gigafactory, a 90-gigawatt-hour behemoth big enough to feed 1 million EVs a year and create 3,000 direct jobs. What sealed the deal wasn't the weather. It was a federal-provincial incentive package worth up to 13 to 14 billion Canadian dollars in production subsidies, tailored to match the U.S. Inflation Reduction Act dollar for dollar. Hot on VW's heels, Stellantis and LG Energy Solution locked in $5 billion for a Windsor battery plant that will churn out 45 gigawatt-hours and employ 2,500 people. Again, backed by multi-level government guarantees. But the boom isn't bulletproof. On May 13, 2025, Honda hit pause on its planned $15 billion Ontario EV hub, blaming tariff turbulence and a softening market. Executives hinted they'd revisit the project once trade visibility improves, a diplomatic way of saying Washington's next move will decide Canada's. Ottawa is determined to keep the momentum. Budget 2024 added a new 10% refundable EV supply chain tax credit on top of existing clean tech incentives, effectively refunding $1.10 on every qualifying brick and robot arm. The signal to boardrooms is unmistakable. If you build the battery north of the 49th, Canada will split the bill. Taken together, these projects are turning the 401 corridor into a lithium-ion spine. And they're hungry for raw material. Nickel, cobalt, graphite, rare earths, all the stuff that lives under Canadian bedrock. Which is why the real scramble isn't for factory footprints anymore. It's for drill permits and exploration stakes. Next up, the critical mineral gold rush that could make or break Canada's battery dream. Canada just juiced the front end of the battery supply chain by extending its 30% Critical Mineral Exploration Tax Credit, CMETC, through March 2027. A move that lets investors write off nearly one-third of every exploration dollar they pour into nickel, lithium, cobalt, graphite, and rare earth hunts. Analysts at Discovery Alert estimate the 2-year extension alone will unlock about 780 million Canadian dollars in fresh drill bit capital for juniors that would otherwise struggle to raise flow-through cash. The money is already moving. Patriot Battery Metals secured 75 million Canadian dollars in flow-through financing to accelerate drilling at its Corvette deposit in northern Quebec, while Volkswagen snapped up a 9.9% equity stake in the same company to lock down 100,000 tons of spodumene concentrate a year for PowerCo's gigafactories. One province west, Frontier Lithium's PAK project just published a definitive feasibility study pegging an after-tax NPV of approximately 11 billion Canadian dollars and positioning itself as the lowest-cost spodumene producer on the continent. Ottawa is stoking the furnace from the policy side, too. At PDAC 2025, the federal government announced 32 new critical mineral projects worth up to 50 million Canadian dollars in combined grants to de-risk early-stage exploration, from Yukon copper to Labrador rare earth pilots, underscoring a strategy to keep Chinese state-owned capital out while luring allied investors in. Meanwhile, the new 10% refundable EV supply chain investment credit, on top of the CMETC, means a miner that graduates to processing or cathode production can claw back even more of its capex. Why it matters? Every ton of rock drilled today feeds the gigafactories of tomorrow, welding mines in Quebec and Northern Ontario to cell lines in St. Thomas and Windsor. In other words, Canada isn't just exporting ore, it's vertical integrating an entire zero-emission value chain inside its borders. One tax credit, one drill rig, one lithium deal at a time. So is this just a commodity cycle, or the foundation of a parallel industrial empire? That question sets the stage for our finale, Northbound and Unstoppable, where we stitch the threads together and ask what sector flips north next. Step back, and the pattern blazes out like a satellite photo at night. Data sovereignty stitched into Kamloops fiber. Freight lines bending east away from tariff choke points. Spanish euros locked into toll sensors. Storage cubes stacking higher beside every new condo. Lithium drills and cathode roll presses syncing to the same metronome of policy certainty. 5 stories. 1 thesis. Capital is migrating to the calmest coordinates it can find. And this decade, that compass points due north. For boardrooms, the calculation is cold math. If your server, railcar, or battery line can operate 10 straight years without a 3 a.m. policy shock, that jurisdiction becomes your default. And when enough giants make that call, the operating gravity flips. Canada is no longer the satellite orbiting a U.S. hub. It's carving a parallel supply chain continent where AI models train, freight rolls, and nickel smelts without crossing a single unpredictable border. The question isn't whether the flow stops, it's which sector flips next. Pharma, chasing patent stability, streaming servers fleeing data subpoenas, semiconductors drawn by clean power guarantees. Drop your prediction below, because every time a board signs a billion-dollar check, we'll be here mapping the quiet coup in real time. If you're ready to follow the money north, smash subscribe, ring the bell, and we'll catch you before the next tide turns. Because in the new North America, the most valuable asset isn't land, lithium, or even AI. It's certainty, and Canada's selling it wholesale.